The pandemic since 2020 is creating a huge shock to the global economy. And we're also observing a scarring effect to the economy all over the world. Now we're talking about 2022, in which the expectation is going to be a recovery, which is driven by the pent-up demand, which is now they are unleashing because of people getting more in terms of their mobility with the ability to manage the pandemic. But what we are expecting to be a smooth recovery and strong recovery now has been overshadowed by another risk, which is coming from both supply disruption, especially on food and energy, not only due to both the speed of the recovery on demand side, which is much faster than the supply side, but also the geopolitical tension, the war in Ukraine, which is creating additional pressure, or in this case, disruption to the energy and food, including fertilizer. And that's creating what we call it the inflation-driven recovery. And that will complicate the policy choice in terms of how you are going to still continue maintain this recovery economy, usually through the supporting both fiscal, monetary, and structural reform. But then, because the inflation is becoming very extreme with the commodity prices, then the choice of the policy is becoming even more complicated and narrower. If we are going to address this inflation, monetary authority need to increase the interest rate and tightening the liquidity. This is what's already announced by European Central Bank, Federal Reserve, and that have the implication on the growth, that is the weakening growth. History also telling us that the increasing interest rate and tightening liquidity can create potential financial crisis. And that's why the United Nations Secretary General now establishing this group in which addressing both the food, energy, and potential financial crisis, because many countries, after 2 years of the pandemic, their fiscal space is becoming very limited, narrower. Their monetary space is also very narrower. And at the same time, they are not yet regained their recovery process. And that's why they are now facing with this kind of increasing interest rate hike due to the inflation, which can potentially erode even more their policy space. These are the situation that is affecting many, especially emerging developing countries, and can potentially disrupt the recovery process.
You mentioned financial crisis, a potential financial crisis and potential disruptions to the recovery from the pandemic. Is this something that Indonesia, as finance minister, you are preparing for?
Well, we have to really always continue open-minded and adjusting our policy. So calibration, recalibration is really required. This is what the G20 also discussing, that all of us really look, it is not like the one template dogmatic policy or direction, but we have to really look at the data and what need to be redesigned in terms of our policy. For example, like in Indonesia, when we have the pandemic in 2020, we opened the cap for the fiscal deficit, which is maximum 3%, to then we allow to have a deficit on our fiscal or our budget at the level of 6.1%. We know that this is increase the public spending because of the health, social, as well as the recovery of the economy, which require government support, while the revenue declined because of the pandemic. But at the same time, the government of Indonesia, we announced that this extraordinary measure will only last for 3 years, in which then we have to consolidate our fiscal situation so that it will continue, have the ability to be effectively as a tools when the economy facing with another challenge exactly like what we are facing today. And that is exactly what the Indonesia is doing. When we are in the process of recovery, our fiscal consolidation is actually starting. Last year even, when we actually initially designed our deficit at 5.7%, we actually end up with 4.7%. 1 percentage point lower, which is, I think, it's remarkable for a consolidation of our fiscal. This year, Indonesia also enjoying some commodity boom, so the revenue increased very, very strongly, while the spending will be kept into the what is the most important priority. First, protecting the people purchasing power. The demand driven coming from the household is very important. Household consumption in Indonesia explain around 54% of our GDP. The second one is try to continue supporting the momentum of the recovery, whether this is through the investment or the export, which is now increased very dramatically because of the global recovery. And then at the same time, we are trying to create a consolidation process for our fiscal policy. So our budget should become healthier with this commodity boom and scaling down the support, because now household is already recovered in terms of the mobility as well as the growth. And also investment is already recovered. Banking sector now start to lend money again. The credit growth has already achieved more than 9%. This is really a very good, strong, robust recovery process.
You mentioned protecting demand and protecting the purchasing power of individuals. And right now we've got oil firmly above $100 a barrel, and Indonesia spending billions in subsidies to help cushion the blow on families and individuals. But this is all coming at a time, as you mentioned, you're still trying to consolidate your finances as you come out of the pandemic. So do you think these current subsidies are sustainable, and are there plans in place to cushion the blow of high energy prices?
Well, the Indonesia economy is unique in terms of the composition of revenue. We certainly enjoy the commodity boom. So the revenue increase, our initial estimation is around more than 2.2% of GDP, even maybe reach to 2.5% of GDP. So that means we have an extra revenue from our original budget design, while the spending will increase maybe by around 2% of GDP, or less than 2% of GDP in this case, meaning that Indonesia have the ability to have this kind of fiscal space to actually finance this additional subsidy. Why we are doing that, especially at this very particular time? Because after 2 years of the pandemic, the recovery process is not yet, in this case, structurally strong. It is still in a very early and very fragile. The household, in this case, consumption, will depend on their purchasing power, that is on their income. The jobless is actually increased during the pandemic. Now it's already creating another new job. So our unemployment rate is actually now declined again to 5.8% from 6.2% when we are in the middle of this pandemic 2 years ago. So this is a very good trend of creating job. That means creating purchasing power because they earn income. And we have to make sure that the inflation is not going to erode this income which is earned by the worker or the labor. And that is exactly why we choose this adding more subsidy, especially coming from a very huge shock from oil and fuel price. You're asking about sustainability. We are still, from our fiscal point of view, continue aiming for lower deficit. So we are on track for these 3 years that the deficit above 3%, but for next year, 2023, we are going to return to below 3%. These are all how we try to combine between so many complex challenges, which is coming, shadowing the recovery process, which is not smooth and simple. And we try to use the same instrument like our fiscal in a very flexible, so priority can be shifted. During the pandemic, our priority is on health and social safety net. During this food and energy shock, our priority is try to protect the purchasing power of the people.
You mentioned that next year starting to look at lowering your deficit. But what happens if oil prices continue to be high, or if we continue to see global supply chain issues and inflation is still elevated? Do you have enough space, or are there anything that you are considering to extend this some support for the people?
Well, we always have this first, continue looking at what is the most important baseline scenario first. I think even today, if you look at the stock market as well as many of the energy price, every day you see the dynamic of the volatility. We do understand that the volatility is going to accompany this geopolitical tension. This situation, which is unprecedented at this very moment, pandemic combined with geopolitical tension. And that's why we have to be very able to really look at the foundation or the fundamental. First, on the financial system, banking sector, we make sure that they do have a cushion to see this and to manage through this kind of volatility on the financial sector. Government understand that the cost of fund is going to be increased because of the interest rate due to the inflation. That's why we have to signal that our deficit is going to be declined in order for us to not getting hit more from this rising interest rate. And for us, your question about how you are going to manage this one, the composition of spending can always then align with what is the most important priority. As I explained earlier, during pandemic, the most important is protecting people from the threat of health as well as social safety net. That is when people cannot go out from their house, they lost their income, and government have to make sure that they are actually getting the support from the government. When they are now able to mobilize or have the mobility, then the threats, it's coming from this food and energy price. You are asking about any scenario next year. No one knows about what is going to happen. Is the oil price is going to be keep increasing, or they are going to be stabilized or even declining with the potential recession will come? So we have to be able to come up with a scenario which is robust enough with those uncertainty which is going to happen next year. Meaning within our scenario next year, there is always a fiscal space which is reserved for anticipating for this kind of uncertainty.
Yeah. Speaking of uncertainty, the markets have been wild this past few days, and now it's all about a potential 75% basis point hike in the U.S., which is more than what people initially anticipated. Is Indonesia prepared for such a hike in U.S. rates?
Well, that is exactly what I'm saying, that with our signaling that we are consolidating our fiscal, and especially because of our revenue, which is increased dramatically, as I mentioned earlier, is even close to the 3% of GDP additional revenue. So we have to make sure that this additional fiscal space will be reserved for us to first declining the deficit so that we don't have to be in a position of seeking financing source when the market is so volatile. I think the Federal Reserve is in a position that they have to deal with the inflation, which is continue pressuring the U.S. economy. So we know that this is going to be the direction that they are going to take. Learning from the history in the past 40 years, then we have to be very vigilant, as I said. It could then accompanied by the tightening liquidity, interest rate increase, strong dollar, that need to be put into account on our ability to manage both on the economic side as well as on our budget side. So yeah, we will continue prepare and be vigilant with this kind of development.
Mm-hmm. And aside from all the volatility, when it comes to high inflation, Indonesia has had export bans on palm oil, for example, to protect the purchasing power of individuals. Mm-hmm. Can I get your assessment of the export ban? How effective was it for local prices and for the global market of the palm oil industry?
Well, we do understand that in palm oil, Indonesia is the largest producer and exporter in the world. So our decision definitely have the global implication on that. Our policymakers at this very moment facing with a very difficult dilemma between protecting their own people, but at the same time also not worsening the global situation. And Indonesia trying to find exactly the right balance. That's why the export ban has already now been removed. But in order for us to be able to guarantee that the domestic consumer, that is our household, will get the cooking oil at the affordable price, there is a mechanism in place in which we try to design the contract between what we call it domestic market obligation, which is going to be fulfilled by all these palm oil producers in order for them to be able to export. I think this is going to be workable. Why? Because the volume of production is actually adequate to actually provide supply adequate domestically at affordable price, and at the same time also providing this production to the rest of the world in terms of export. And today, even tomorrow, I think I've already issued this ministerial decree for us to be able to strike the right balance for the producer, for them to be able to fulfill their domestic obligation. We also calculating their cost implication of this domestic market obligation, while at the same time they are able to continue export. And we also getting the windfall profit because many of these producers enjoying extremely high CPO price at this very moment.